Hello, my name is David, and in this video we'll be talking about crossing moving averages strategy. Now, many things have been said about this that is very popular. Often it's used with other adjectives or names associated with it, that it's magical, there's secrets, there's tips, that it's amazing. So I thought of doing a video where I'm going to, of course, explain what is the moving average cross strategy, but I'm also going to show a real study of it using that strategy, using real data, and calculate and see if indeed it is a useful, valid trading strategy. I'm hoping that you take your own conclusions, and so I'll start with explain what it is before we move before we move into to how to do this. So in my screen, we're currently looking at the Standard & Poor's 500 daily chart. So as you can see here, each candle is 1 day, of course. And I've already plotted two moving averages. I'm not going to explain what are the moving averages, but there's plenty of content about that. And if you do think it's useful, I can perhaps do a video to explain it. But anyway, so in this chart, I've plotted two moving averages. One for the 50-day moving average, which is the red line. And the other one is the 20-day moving average. On these two moving averages, I use the close price. So when you calculate the average, you'd only take into account the closing price. So let's say if it's the 20 moving average, you get the last 20 close prices, you sum them up and divide by 20. That's basically what the average is. And the moving average, basically the moving is there because as the day progresses, you move forward 1 day, you do the last 20 days. And of course, the same thing for the 50 moving average. And it's called a simple moving average because you could obviously use other types of moving average. You could do an exponential moving average, etc. In the moving average, every close price has the same weight. On the exponential moving prices, that is not the case. But we're not going to cover that. It's just to highlight what I'm using here. So in this case, I just have some data you can see up and down. So what is the moving average across strategy? So basically, the strategy is defined as when you have the 20 moving day average, or sometimes called a fast moving average, crossing above the 50 moving average, like here, as you can see. You would go long, or you open a position, you enter the market, and you stay with it until the 20 moving average crosses below the 50 moving average, or again, to use different words, when the fast moving average closes beneath the slow moving average. I could have used any moving average. I just used 2050 for no particular reason. The principle applies for any of them, and it's just to illustrate the principle. So hopefully, of course, the other thing I wanted to add, sorry, before we carry on, is you can, if you wanted to, you could also go short. So you could take the opposite trade whenever the 20 moving average goes beneath the 50 moving average. So in this case, for example, you would have gone long here, you would have closed your position when it crossed here, and you were inverted to a short, close your short here, go long, and so forth. You could also have done that. For simplicity, I'm just going to consider that you go long, that you enter the market, that you buy the market when the moving average crosses. So again, when the 20-day, goes above the 50, the slow moving average. So in simple terms, that's what the strategy is. And you can find lots of content everywhere in the internet and YouTube. There's tons of videos, a lot of people talking about this, and sometimes a lot of hyperbole is using this because it's very simple, it's fantastic, it's magical, and there's fantastic things said about this, but I want to make this video for you to take your own conclusions. And of course, there's some people call refinements. You can add a third moving average to do a third indicator to refine this principle, or you can do other things. But the core of this strategy, the principle, is what I just said. So let's study this again. I'm going to use Excel because the point of this video is to show you how you can do a lot of studies, a lot of data calculation using a simple tool as Excel, and this is what I'm going to show. So again, I'm using a familiar data set. I have the daily Standard & Poor's data from beginning of 2004, as you can see here, so the first day of January, all the way to almost the end of July 2021. So roughly 4,400 something days of data. And again, I have the 4 columns here, the open, the high, low, and the close, the usual thing. So the first thing I did was to calculate the 2 moving averages. So I've calculated the 20 moving averages. Is very, very easy. So I've chose the last 20 days, including the day itself, and then the same thing for the 50 days average. And of course, you could have, on your own study, you could have choose whatever numbers you want. You could use a 10, 20, or the 50, 200, the 13, the 21, whatever number you want. This is just a principle and show you how to, and then you can always do at your leisure whatever studies that you do. And again, the other thing I'd like to say is these days, it's very easy. There's a lot of software out there that you can use to do this in a sort of automatic way. It calculates everything for you. There's a lot of choice. Gone are the days where there's very few tools that you could use. These days it's very easy. There's a lot of tools, a lot of applications can do this for you. But I'm still showing how easy using an Excel, a very common tool. And even if you don't have Excel, this is something that I have wanting to be mentioning in other videos and failed to do so. Even if you don't have money or you don't want to spend the license on Microsoft Office to have Excel, you can use OpenOffice. It's free and it's a pretty much equivalent spreadsheet, and anything is here you can easily transport to OpenOffice. Again, if there's a lot of requests, I can do a video about OpenOffice, which I also use, and it's a free tool. Anyway, carry on with what I was saying. I've calculated 2 moving averages here, and you could have done whatever you wanted, and nothing forbids you to use more than 2 different ones, and you calculate and you can do what's called an optimization, where you look for the best moving average for the instrument you're looking at, in this case a Standard & Poor's. So then I've added another column which I call the signal, and basically the signal is what I was explaining with the chart before, is when the 20 moving average is above the 50 moving average, the signal triggers you to go long, and if it goes beneath it, like it happens here, then it tells you to close the long. For the time being, we're not considering shorts. So very simple. The formula I've used here, again, it's very simple. If that value greater than that, then 1, basically to signal that equals 1, to signal that the signal is on, otherwise not. So, and I've done this. And then on another column, which I call the long open price, I've actually put the price here. And this is where you have to pay attention. There's a few things you have to be careful to make sure you get the right study. So in this case, I said, if the value on this column, so if the signal is 1, so if the moving average, 20 moving average is above the 50, and the previous value is different from 1, so basically there was no signal, so it's just crossed, because you don't want to be opening a new position every time the moving average is above. You just want to open once, then get the open price. But this thing is, you're going to want the open price of the next day, because obviously on that day the moving average is if the market just closed, you cannot open knowing in advance if the moving average is going to be above or not. So you have to wait for the closing price of the day, see what your indicator provides, and then the next day you can act on the signal from the previous day. So there's no forebounding. Sometimes I've seen studies of a moving average, and they do this little trick where they basically use a signal. in advance of it is, so they open in a day before even knowing if there's a cross or not. So that's an important detail. Otherwise, if there's no signal, just transport the price from above. And then I've done a similar thing for the closing price. I said, if the column for the signal is 1, but then on that day is no longer 1, so I put an AND operator here. So if this is different from 1, but the previous one is equal to 1, then you get the closing price, the next day open price to close your trade. And again, it's the next day, not the current day. In this case, you could open an exception. You could say, or you could be there right at the close of the market, see if your moving average is going to cross, and take action, close your position, or even open your position to close price. But for sake of simplicity, to avoid any confusions and any leaving you any possibility of manipulation, you say you have to wait for the closing price, and then whatever the moving signals is generated, you can take action on that on the next day open. And this is what it is here. So you have to close your position on your next day price here. So you can see today it uncrossed, and only on the day there, on the open the next day, you get the price. And then one last column where I basically calculate what was the gain or loss for that cross. So as you can see here, there was a gain of 1.58, 1.59% if we round up for this trade. And again, very simple. I used an AND operator here. So I said, if this value is different than 1, so it's no longer the moving average, the fast moving average is no longer above the slow moving average, in this case a 50-day, and the previous day was still 1, so the uncrossing just happened, then calculate the win, which is basically the closing price minus the open price, and you do the percentage, and there you go. And I just carry on doing this for the rest of our data. You can see here some of the positions you stay for it. So for instance, this position, it was open on the 10th of September 2004. You were long all the way until 3rd of November, and on the 3rd of November the signal uncrossed and you closed on the 4th of November. As you can see here, you closed at this price for a gain of 1.60%. So that's an spreadsheet showing you this moving average crossing, the crossing of the moving average strategy in values that you can actually see, not just theory. And then I did another column here, more for an extra. It's not essential, which is just carry on. So you made that one and you carry on, then you lost here. So it's basically an accrued. So you can see as you move on what is your overall, your total gain or loss. Again, as usual, I calculated some very basic statistics which will help us take our own conclusions. Is this strategy profitable or not? So how many trades were done? There were 48 trades done long, so basically 48 crosses. Out of these 48, 29 were profitable, so that's around 60.4% of the trades were profitable. So you think, okay, the win rate is very good. You might be inclined to think, oh, this is fantastic. But just before we take any conclusion, let's carry on with the analysis. This is the average, it's all in percentage, so our average gain was 1.60%. The median, so the middle value, was 0.96%. And then there was a maximum. What was our highest gain? Was 16.3%, 4% roughly. And the minimum, so the biggest loss was 11.6%. So if you add up everything, your total gain from all the way beginning of 2004 to 2021, the end of July 2021, was 76.98%, more or less. So this study does not take into account things like commissions or slippage. Assumes you manage to get into the trade to the exact price listed and exit at exact prices, so no slippage and no commissions. I put here a value here showing just a little bit of example with a commission. If I use a fairly average commission of 0.02% per trade, this would have been your overall your overall gain with commissions. But again, it's just to give you a slight an idea for what it is. So you might be thinking, first approach, okay, actually, 76, 98%, this is actually looks good. But let's start to go deeper and see what value that this gives us. Well, if you divide by the number of years, 17 years worth of data, you come down to a 4.47% gain per year, which is, I'm not saying it's bad, but it's not amazing. It's more on the humble side. Plenty of indexes make more than this on average every year. So it seems you're below the benchmark. And now I actually have calculated the benchmark for this period data, and I blanked it so you wouldn't see it, so you would not be immediately biased. But I'm going to show you how much that is. And had you stayed in at the first beginning amount, your total gain would be 395%. So almost 400% gain. So if you take this as the benchmark, so you're hoping that your strategy will give you something equivalent or better, or if you have other arguments that justify to accept a gain beneath the benchmark, this is what you're looking for. So we're looking for at least a quarter of gain with this moving average, crossing moving average strategy. So a lot of people try to defend this approach, saying yes, but one of the benefits is that you're actually not in the market the whole time, because obviously if you invested the whole time, you buy and hold, you're in the market the whole time, so you're exposed to greater risk. Well, what I have to say about that argument is that if you calculate how many days you're in the market, for a total amount of 4,374 market days, you're actually in the market, you're invested 2,961 days. That's 67.7% more or less of the day. So pretty much almost 2/3 of the time you were in the market. So it doesn't really help you to be out of the market and only be in the market when you're making profits, if you want to call it like that. So that argument is quite weak. So you actually end up being invested a lot of the time for only a fraction of the profits. So let's say if you round this down, you means you're invested only 2/3 of the time you're in the market, but you're not making 2/3 of the profit. You're making barely less than a quarter for 2/3. It's not great. It's not great. Then another common argument is, well, but the moving average crossing strategy actually allows you to not only be long, but then you can take the opposite direction when it goes down. You go short and you profit from that downturn of the market. Well, I've calculated that as well. I had hidden here the values. And this is the same values. Again, I've used a similar formula here. I'm going to put the formula here so you can see it. So I won't explain it, but if you want to pause the video and use this formula and look how it's done. And then again, that's the open price. This is the closing price. And then that's the formula to close. So I did the same thing I did for the longs with the shorts. And what's the conclusion? Well, 48 trades. Out of these 48 trades, 15 were profitable. That means it's only 31% of your trades were profitable if you take the short. As you can see, the values are very bad. Your average is a loss of 1% per trade. Your middle value is minus 1.64. The maximum gain you did here was 21%. Your maximum loss was 10%. But overall, you lost 50%. So if you were to take the short, you would actually be losing 50% out of your 56. So that would only leave you with 26% profit. So again, that argument that using the moving average cross to allow you to be long and short, again, doesn't seem to have any validity when you actually do the values. I've charted a few more things here to show, because sometimes showing numbers can be a bit dense and difficult to comprehend. But I've charted, this is a chart one. So this is the profits of only going long, because that argument about the fact that there's a similar argument to one I was saying, where you reduce your exposure to the market because you're not the market every day. You only in the market where you're prone to be making profits, and therefore when the market is a downturn you should be out, and basically reduces your downturn, your losses, your drawdowns. But if you look at the chart, is actually your drawdowns, you actually have very large drawdowns even using this system. So you have a drawdown of 5% here, another drawdown of 6 point something, you have a drawdown here of 11%, another one of 9. So it doesn't reduce your drawdowns. Yes, you have large gains, but it's not a benefit that you can see. And then another aspect you can see is you can just see the total, and you can still think, well, I know all those things, but it still returns you a positive value. Well, let's yet look at another perspective of this long value, this positive value, and see what you can take. So I've charted another thing here, and this is the accrued returns on this strategy. And if you look at this, it doesn't actually look great. Yes, you have 76% gain over 17 years worth of data, reminding that your gain per year is only 4.47%, which is very weak. Most of the indices, on average, they gain between 6-7%. This is perhaps another video we could do to show average gains on year of some of the main, the most popular, some of the bigger indices. But looking at this, what can you see? Well, you can see that if you had started on the beginning of 2004, at the very beginning, by what's the date here? By February 2010. So 6 years. So 6 years after you started, you're still under. You're still underwater. You're still beneath zero. Look, February 2000. So for 6 years trading with this strategy, you're still under zeros. And then you go into positives, and then you spend another 2 years roughly around this before it actually takes off. So only from 2012, so basically after another 8 years of pretty much going anywhere, you make some money. So think about this. Would you have been able to stay faithful, have the psychology to continue to use a system that it was not only taking you to negatives all the way to 2009, and then even then not making anything until 2012, and then yes, taking you to profit, but even then under delivering from what everything is being delivered out there. So I'm going to finish here. I don't want to make this video much longer. There's a lot of things that could be said about this. I want you to take your own conclusions. What do you think? Obviously, if you think that, perhaps the results are not great because you're using the 20-day and the 50-day moving average, perhaps what you should have used is the 15 and the 100 or whatever. I invite you to do this calculation. You could do it very easily. You can choose whatever moving averages. And I've done this study myself, optimizing for each index, trying to find the best combination, the worst combination of moving average, using simple moving average, exponential moving average, adding a third indicator to try to crop out your losses and trying to just stick to the positives. I've done all these studies myself. I would invite you to do the same. If you have any questions on how to do this, please feel free to leave them. I'm happy to address them, but I want you to take your own conclusions about this. For this case, what you can see with real data, you can see the results are, let's say, poor. So whenever you see out there videos telling you how amazing this simple strategy is, how fantastic, how this and that, well, take your own conclusions, do your own studies. Of course, you can do this study for FX pairs, for commodities, for futures, for your favorite cryptocurrency, whatever you want. You can use a simple Excel spreadsheet to do this. Obviously, there's other ways, more efficient. You can do even more studies with this. You could calculate your maximum drawdowns, your expectancies, your returns. There's a lot of values you could do this. This is a very rough view because I thought it was very worth it to have a video about the simple moving average cross strategy. Likely in the near future I'll be doing similar videos about other popular trading strategies where I will show real values and real returns calculated, because it's something that often no one shows you. They just explain you, they tell you it's amazing, but no actual values there. Anyway, thank you for watching. I hope you find this useful. I hope you find this inspiring. And thank you very much for watching. Goodbye and see you soon.